Hey everybody, Greg Barron here. Thanks for joining our YouTube channel once again, The Professor of Real Estate. And today we're going to dive into some meaty stuff, so you're going to want to stay with us. So I'm going to talk to you about three things that every real estate investor needs to know. And this will apply whether you're doing small deals or big deals. The first thing I want to talk to you about is what factors affect capitalization rates. The second thing I'll talk about from investing is just what are good investment returns. The third thing I'm going to talk about is a term we call capital buckets. It's what are the expectations of returns for different capital buckets of assets. So the question I get asked often is just what factors go into determining a capitalization rate in the first place. So basically there are 6 factors that go into it. The first is the current interest rate structure. So let's think about it this way. It doesn't take much effort right now to determine if I have $100 to invest today, what vehicle could I put it in to earn what I call a risk-free rate of return. So as you're going to see by the graph as of today in January of 2024, that risk-free rate is somewhere around 4%. So as you can see from the graph that I've just pulled up, today's current risk-free rate on a 10-year Treasury is right at 3.975%. If I've got $1,000 to invest today, I know with certainty that I'm going to earn close to 4% on that. So reason says that interest rates affect cap rates going forward, and they've got to be higher than 4% on anything I'm looking at today. So any return I get has got to have a premium above that. That's number one in the capitalization mix that we want to measure. The second thing that affects cap rates are comparable sales, or comps as we call it in the industry. Anybody that's ever bought any kind of real estate, particularly if they've put any debt on it at all, has had to get an appraisal. This appraisal is going to give you comparables within the area. And normally those comps are going to be like properties that have sold within a certain time frame that produce X amount of value that you can compare your product with to something that's got a trailing history to. The third factor that affects the capitalization is the age of the property. Obviously, aged properties are going to be, we'll call it more seasoned. I like to be called more seasoned and not old. But those properties are going to have more wear and tear on them. They're going to have more maintenance issues unless they've had some kind of value add over the years. But property age is a very important factor in capitalization. In certain asset classes, you'll classify them as A, B, B minus, B plus, C, and some that are just plain dogs. But age is going to be an important factor that affects capitalization rates. The fourth thing in determining a capitalization rate is really the condition of the property. This goes along a lot of times with the age. This exposes a lot of hidden factors that, frankly, it's going to require a tremendous amount of due diligence in the buying process to do after you've determined whether it's a go or no-go. I'll give you a quick example. In the last few years, we were involved in an acquisition of a 24 property portfolio in about 12 states. After we determined that this acquisition was in the realm of probability, we took a microscope to the properties. And the most important things we did in this process were we started with the exterior envelope and worked our way in to determine the actual condition. We had a checklist, as we always do. The things that we look for from experience, frankly, some other people may not be able to discover. As a real estate investor, you don't want to get caught in the emotional trap of falling in love with something just because the numbers on the surface work out, because you could have a lot of hidden issues that are going to impact your returns in years to come. So you want to look at 4 or 5 significant things during your forensic exam that very well could uncover things that could affect your return in the years to come. As a rule, we always start with the exterior envelope. Those typically are those with the highest impact of cost. We start with the roof. Now, whether in an industrial facility where you've got, say, a single ply roof, or a multifamily where you've got 3 tabs, you really want to see when that roof was installed. In the case of most of these roofs, we'll have a third-party inspector come along behind us if it's of significant value, to have them give us a report of what useful life we think it will have in the future. We then start to go around the building envelope. We look at the structure. We want to look primarily at all the HVAC or rooftop or split system units to see when they were put into place. Has it had any modifications during the life? If it's reaching about 15 years, in most cases, we know that it's got very few years left, and we need to factor that into the purchase price, or in many cases, subtract those prices from the ultimate value. Then after we've done the envelope, the HVAC, and the grounds, we move inside to look at the interior finishes. Even in the case of finishes, we want to see what kind of life is left, because we could have a material impact in year 2, 3, or 4 if we hold it that long. The fifth thing we want to look at is if it's got any value add upside. Now, this is for particular assets that we think we can come in and modify, increase rent, and increase ultimate value with a going out cap rate that's better than what we went in at. And the last thing is property location. One of the rules that's becoming really apparent right now, especially with the dynamics that are going on in cities, is we want to go to municipalities where they actually like our money. So I'll explain just a little bit what I'm talking about. In more and more municipalities, it's becoming more and more difficult to develop because of the impact of the fees that they're placing on developers. And a lot of investors that are in multifamily in cities like Washington, D.C., New York, Chicago, to name a few, are experiencing the tremendous headwinds that rent caps are placing on their ability for their properties to perform like they had originally anticipated. So it's extremely important for you to do your due diligence in municipalities to determine if they like your money. So the second thing I want to talk to you about is what are good returns. So I want to break it down into 3 specific areas. First off, what I look at is cash on cash. The second thing I look at is what is the equity multiple. And then the third thing I look at is what is the expected going out internal rate of return. These returns I'm going to show you, I'm going to center on the asset class of multifamily for the purpose of this particular video. So you need to remember as an investor that return should also be aligned with the amount of risk that you're going to take on that particular asset. So with multifamily returns, we're going to have different cash on cash return expectations. If we look at something that's been seasoned, that's been in the market for a long time, it may need some value add to it to prop up the rent. We're going to have naturally more risk to it. So we're going to require more of a return, so it's going to be on the upper end. And my usual range is between 5 and 9%, depending upon all of those factors that go into what I previously talked about. What kind of risk am I going to take? On the other hand, if we're looking at something that's fully stabilized, it's fairly new, our expectations on the return could be trending toward the lower side because we have some history and we know we're not going to have a lot of upkeep. We can fairly predict what our escalations will be. However, it's been a little difficult lately because of property taxes and insurance. But our cash on cash return would be on the lower end of that spectrum. But they've all still got to be several hundred basis points above my risk-free market rate return that I could shove money into a treasury with at the end of the day. The second thing we look at is equity multiple, and every investor is going to want to know, if I invest $1,000 here, what kind of multiple of that am I looking at in the term if I hold it for a specific amount? And again, it all goes back to what type of asset is it. On the lower end of the spectrum, if it's stabilized and we're only looking to hold it for, say, 3 years, my particular equity multiple is going to be between 1.5x and a 2x. On the other hand, if we're looking at this for a longer term, specific to multifamily, if we anticipate holding it for, say, 7 to 10 years, it's reasonable to say that there will be more risk in the life, so our returns should be longer. In addition to that, you're holding my investment money for a longer term, so I want my equity multiple to be larger. So on a 7 to 10 year hold, we expect greater than a 3x on our original investment. So let me give you an example of an equity multiple, just showing you two figures. I've already loaded this into Performa Plus. Now, there's a bunch of numbers that are on the back side of this, including development cost, building income, stabilization, and so on and so forth. But I want to draw your attention to two specific things to let you see what an equity multiple is. If you'll look right here, this will be the original investment, around $10 million of a cash investment. And then as we've run the numbers and done the sensitivity analysis, from an investor standpoint, this one will achieve a 2.18 equity multiple, or a total return of around $20 million in distribution over the life of the project. So specific to my previous example, that I wanted to achieve at least a 2x to investors over the life of project if it was a 3 to 5 year hold. You'll notice on this particular project, we went 5 years out. We achieved a 2.18 multiple, so it fits within the 1.5 to 2x of our equity multiple. Now this is prior to looking at the total internal rate of return, which I'll get to next. So we've looked at cash on cash, we looked at equity multiple, and the last item is internal rate of return. So just like cash on cash return can vary depending upon if it's a seasoned product, or if it's fully stabilized, or if it needs a value add, the same thing applies to internal rate of return. It just depends. Usually you want to look at something on a minimum of 8%, and maximum on internal rate could be 20% and higher for investors, which leads me to my next explanation of capital buckets. So investors normally identify capital buckets in 4 basic classes within a specific asset class. So again, taking multifamily as an example, let me give you the 4 capital buckets that usually apply to multifamily. These 4 are typically core, core plus, value add, and then opportunistic. So among these core bucket classes, the return that we expect usually goes from low to high in this order of core, core plus, value add, and opportunistic. As we go down each one of those, the risk for return and the risk associated with owning or developing gets a little bit higher. So it stands to reason our expectation of our internal rate of return, which is basically the sum of all cash flows, and then you add on the exit value to get your year-over-year return discounted back to the present value. So typically the lowest risk asset in the capital bucket class are the core assets. Now let's take multifamily for example. If it's an interior CBD project, Class A, fully stabilized, you would normally expect an internal rate of return no less than a 7 and typically no greater than a 10%. The second asset is the core plus in this capital bucket exercise. Typically these aren't in the CBD areas, but they're very strong class of asset, usually fully stabilized with a lot of history to it, and normally you can anticipate somewhere between a 10 and a 13% internal rate of return. Now of those first 2, core and core plus, you find mostly institutional investors or insurance companies or family offices that are placing money in those particular assets. They don't want to manage them. They want them to be fully stabilized. They want a specific return. They want mailbox money. That's why the internal rate of return is more predictable and usually a little bit less than the next 2 that I'm going to describe. So the next capital bucket is what we call the value add. Again, let's stick with multifamily for right now. But this could apply to other asset classes as well. So this value add specific to this capital bucket of assets is typically something that is established. It's got a trailing history of income. It's got some opportunity to increase rent, but it's going to have higher risk than the other two prior classes. Normally, this capital bucket is going to require an internal rate of return of anywhere from 13 to 17% with the risk that you're going to take on with this particular asset. So this last asset class, along with the value add class, are two of the most classes where most people look to get a higher level of return. Opportunistic is going to have the most risk and therefore require the highest expectation of internal rate of return, primarily because the longer it takes to do a new development, the longer you open yourself up for potential risk. And there's no history of stabilization or a guarantee that that return is going to hit the mark. So typically in the opportunistic class that we're referring to, we're going to require anywhere from a low of 15% to 20% plus in the expectation when we develop our internal rate of return strategy for investing. As always, if you're enjoying the video, be sure and hit the like and subscribe so we'll keep pumping out more information to help you as investors. So the last thing I want to talk about as we jump into the software is how that cap rate can drastically affect your going out price and establish your return, and why it's important for you to do this sensitivity analysis and this financial modeling anytime you're trying to determine if this is a good investment or not. So as we jump back into the software, I want to show you how a cap rate can affect the sales price and ultimately affect your ultimate return over the life. And a lot of you might be wondering just why buyers and sellers' expectations aren't aligned right now, and there's not a lot of movement in this space, and I'll show you as we jump into the software. So take a look at this same project, and I've loaded a 4% cap rate, which was pretty typical of a few years back of the multifamily space. And then we're going to look at a 6% cap rate, which is closer to what the expectations are today. So look at the difference just in the sales proceeds before tax. When this particular project was loaded, it had a going out sales proceeds before tax of $40 million based upon a 4% cap rate. Now fast forward 2.5 years later, and cap rates are moving closer to 6%, if not over, for this particular asset. And that same project that was going for $40 million is now only yielding close to $18 million in a going out sales proceeds before tax. That is close to a $21 million difference just because the cap rate changed from 4 to 6. This is why we are in the market that we were in today, while we're not aligning buyers and sellers' expectations. Sellers are not willing to give up that $22 million yet, and buyers aren't willing to pay because they're waiting to see what that cap rate is going to be going out as we move along through this year. So these are the huge disparities that we're dealing with right now. And basically, it's a game of chicken. Somebody's got to move, and nobody's willing to just yet. But at some point, sellers' expectations have got to line up with buyers' expectations, and there will be movement in the market. Just not yet. Thanks for joining us again today. Remember, educate, evaluate, so that you can ultimately execute to increase your own personal wealth. See you next time.